Hey friends, welcome to the Singapore Market Digest for Monday, May 26th. Twimpy, I'm Iggy from the Investing Iguana, and today we're diving into what's been happening on the SGX. We've got some interesting earnings updates from several key players across different sectors. From aviation services to luxury retail and dining, let's break down what these companies are telling us about their recent performance and what it might mean for investors. The Singapore market has been showing mixed signals lately, with some sectors benefiting from economic recovery, while others face ongoing challenges from inflation and changing consumer behavior. Let's start with SATS Limited, ticker S58. For those who might not know, SATS is Singapore's main in-flight catering company. They handle food services for airlines at Changi Airport and other locations across Asia. Think of them as the folks making sure your airplane meal gets on board. SATS is actually much more than just catering, though. They also provide ground handling services, cargo handling, and airport terminal services across multiple countries in Asia Pacific. SATS just reported some pretty solid numbers for their fourth quarter ending March 31st, 2025. Net profit jumped 18.3% to $38.7 million compared to $32.7 million last year. That translates to earnings per share of 0.026, up from 0.22 in the same period last year. What's really impressive is how consistently they've been growing their profit margins quarter after quarter. What's driving this growth? Revenue climbed 10.4% year-on-year to $1.5 billion from $1.3 billion. The company says this boost came from higher business volumes and better rates. This makes sense when you think about it. As air travel continues recovering and growing post-pandemic, SATS benefits from more flights needing their services. Changi Airport has been seeing passenger traffic return to near pre-pandemic levels, and this directly translates to more business for SATS. The company's current market capitalization stands at approximately $4.5 billion, making it one of the larger players on the SGX. Their price-to-earnings ratio is sitting at around 22, which is reasonable for a company in the aviation services sector that's showing steady growth. Here's something that should make income-focused investors happy. SATS proposed a final dividend of $0.35 per share, payable on August 15th. That's more than double their final dividend of $0.15 from last year. This dividend increase shows management's confidence in their cash flow and future prospects. The total dividend yield for the year is now looking quite attractive at around 3.5%. Interestingly, despite these positive results, SATS shares ended flat at $2.98 on Friday. Sometimes the market takes time to digest good news, or perhaps investors were already expecting these results. The stock has actually been on a steady upward trend over the past year, gaining about 25% as the aviation sector recovery story continues to play out. Moving to luxury retail, we have the Hourglass, ticker AGS. This company sells high-end watches from brands like Rolex, Patek Philippe, and other luxury timepieces. They operate stores across Asia, including Singapore, Malaysia, Australia, and have been expanding their presence in key luxury markets. The Hourglass is actually one of the largest luxury watch retailers in Southeast Asia and has built strong relationships with top Swiss watch brands over decades. The Hourglass reported mixed results for their 6 months ending March 2025. While revenue grew 9% year-on-year to $622.6 million from $571.3 million, net profit actually dropped 6% to $74.4 million from $79.5 million. Earnings per share fell to $148 from $217 previously. This is a classic case of top-line growth not translating to bottom-line improvement. The company explained that their profits got squeezed by rising operating costs. They're dealing with higher rents and wages due to inflation, plus they had to adjust the fair value of their investment properties. This is a common challenge many retailers face right now, growing sales but shrinking margins due to cost pressures. Retail rents in prime locations across Asia have been climbing steadily, and luxury retailers like the Hourglass need those premium locations to attract their target customers. The luxury watch market can be quite cyclical and sensitive to economic conditions. When people feel uncertain about the economy, they might delay big-ticket purchases like expensive watches. However, the 9% revenue growth suggests there's still strong demand for luxury timepieces, especially in Asia's growing wealth markets. The region's growing number of high net worth individuals continues to drive demand for luxury goods. The Hourglass currently trades at a price to earnings ratio of about 14, which is relatively modest for a luxury retailer. Their market cap is around 1.2 billion. The company has historically paid steady dividends, though they may need to balance dividend payments with the need to invest in store renovations and digital capabilities. Shares of the Hourglass closed flat at $1.61 on Friday before these results came out. The stock has been relatively stable over the past year, reflecting the mixed sentiment around luxury retail in the current economic environment. Now let's talk about Japan Foods, ticker 5OI. This restaurant operator runs various Japanese dining concepts, including Yakiniku Shakudo, Ajisen Ramen, and Menya Musashi. If you've eaten Japanese food at a mall in Singapore, you might have visited one of their outlets. The company operates over 100 outlets across Singapore, Malaysia, and other Southeast Asian markets. Unfortunately, Japan Foods is having a tough time. They reported a loss of $6.2 million for the second half of their fiscal year ending March 31st, 25. This is much worse than their loss of $576,000 in the same period last year. Revenue also declined 7.5% to $40.2 million from $43.4 million. These numbers show a company that's struggling with both declining sales and widening losses. The company blamed tough market conditions for their struggles. Their existing brands are generating lower revenue, which suggests customers are either eating out less or choosing different restaurants. The restaurant industry has been particularly challenging post-pandemic, with changing consumer habits, higher costs, and increased competition. Food delivery has also changed the game, with many restaurants having to pay significant commissions to delivery platforms. Loss per share widened significantly to 0.36 from 0.33 last year. The company also didn't declare a final dividend this time, unlike last year when they paid 0.2 per share. This shows they're trying to conserve cash during difficult times. With a market cap of only about 37 million, Japan Foods is considered a small cap stock that faces significant challenges in the competitive F&B market. Surprisingly, Japan Foods shares actually climbed 2.4%, or started out 0.05 at its dirty low as 250 on Friday. Sometimes stocks move on hope for improvement or because the results weren't as bad as some investors feared. Small cap stocks can also be quite volatile due to lower trading volumes. Finally, let's look at Manulife US REIT, ticker BTOU. This REIT owns office buildings in the United States, primarily Class A properties in major cities like Atlanta, Denver, and other key markets. REITs are popular with income investors because they typically pay steady dividends from rental income. Manulife US REIT has been facing challenges due to the changing office market dynamics in the United States. Manulife US REIT announced some important news on Friday. They got approval from lenders to extend their asset disposal deadline by 6 months to December 31st. They're also using $25 million in cash, plus proceeds from selling their Peachtree office building in Atlanta to pay down some debts due between 2026 and 2028. This is essentially a financial restructuring to give the REIT more breathing room. This extension gives the REIT more time to meet their obligations under the master restructuring agreement. Essentially, they're working through some financial challenges and need more time to sell assets and manage their debt load. The REIT has been under pressure due to high debt levels and challenging market conditions for office properties. The U.S. office market has been particularly tough recently. Many companies are still figuring out their post-pandemic office needs, with remote work reducing demand for office space in some areas. This makes it harder for office REITs to maintain occupancy and rental rates. Office vacancy rates in many U.S. cities remain elevated compared to pre-pandemic levels. Units of Manulife US REIT closed 1.6% higher at US 0.062 on Friday before this announcement. The market seems to view the extension positively, as it reduces the immediate pressure on the REIT to make forced asset sales. However, the unit price reflects the significant challenges the REIT faces, trading at a substantial discount to its net asset value. These earnings updates give us a snapshot of different sectors in the Singapore market. SATS shows how companies tied to travel recovery can benefit from increased activity and operational efficiency. The Hourglass demonstrates the challenges retailers face from cost inflation even when sales grow. Japan Foods highlights the ongoing struggles in the restaurant sector where competition is fierce and margins are under pressure. And Manulife US REIT reminds us that some property sectors are still working through structural changes that may take years to fully resolve. For investors, these results emphasize the importance of understanding each company's specific situation, rather than making broad market assumptions. Some sectors and companies are thriving, while others face headwinds. The key is to look at the fundamentals, management quality, and long-term prospects, rather than just short-term results. As we look ahead, keep an eye on how these companies navigate their respective challenges and opportunities. The Singapore market continues to offer diverse investment opportunities across different sectors and market caps. That's the scoop for today. Remember to do your own research before making any investment decisions. This is Iggy from the Investing Iguana signing off.